All right. Well, as people continue to trickle in, why don't we go ahead and get started? So everyone joining, thanks for spending some time with us, and I think this is going to be a really exciting talk. I know I'm excited to hear it as I've gotten to know Brett more and more. So Brett and I connected through the small world of plastic surgery, actually, as his cousin is a very well-known plastic surgeon and also the editor-in-chief of one of our major journals. And ultimately, he ended up connecting Brett and I, and we wrote a paper together and are continuing to do a bunch of research in the area of financial well-being and physicians in general and surgeons. And that just led to a really nice friendship and kind of a lot of discussions about finances and all the things that, I'm interested in. And I think Brett has a really great perspective on this stuff, obviously, given his career, but he also just is a very sort of clear thinker about this stuff. And so I've learned a lot just from chatting with him. And so that's why I invited him to come on and to share some of his thoughts about overall investing strategy. And, you know, it's going to be a lot of great points to hopefully discuss afterwards. And we'll have some good time for Q&A. So, and I should say, Brett is the principal of Strongbridge Advisors, and that's sort of what he does on the professional side, outside of all of his hobbies of finance research and things like that. So, Brett, thanks so much for taking some time out of your busy schedule to join us, and I'll pass it off to you to kind of get started.
Okay, great. Thank you, Jordan. Thank you for that kind introduction, and hello, everyone. As Jordan mentioned, I am Brett Janis. I'm based in San Francisco. So I am a practitioner in the field of investment management and wealth. And I do have medical professionals and surgeons as clients and thought partners. So would love to share my views with you. I don't know exactly some of people's backgrounds. We do have a small group, so we can definitely make this interactive. I know this is cutting into your valuable personal time as well, so I do want to make this very impactful. And my overall goal is really to just instill some practical framing, discuss some foundational principles, share some of my learnings as a practitioner, having done this for, decades, and then try to avoid as much as possible unnecessary technical jargon, so that this is, sort of action steps and things that are in some ways common sense and easy to understand. So in terms of what we thought would be most helpful to talk about, we can start by introducing what we've dubbed this two-pillar framework in terms of achieving good success with outcomes. We'll talk about the first one in depth, which is more about financial planning, and then we'll talk about some key principles on investing. I can address a couple myths that I commonly hear people discuss with me about markets and sort of major issues. And then if there's interest and we have time, I'm happy to kind of address today's market conditions and talk about that as well. Okay, so let us jump into this basic framing to hopefully kind of guide this discussion. And we have called it the two-pillar approach framework. That's really a device to just emphasize that both pillars are really important for your financial success to really stand in terms of what we're trying to achieve. And you can do one of these pillars well, and if you do, but that's not sufficient to really have good outcomes. You really do need to have the core principles in place in both regards. If you don't have one or the other, then it is probably a real big drag on the overall plan. So the first pillar is really about financial planning and some things that I would suggest are largely under your control. So, and this is a lot of what Jordan, you do on the website. You talk about. It's about budget and lifestyle choices. It's about good hygiene with retirement contributions and structuring those. It's also, increasingly as you, develop through your career, about protection and insurance issues to cover sort of tail risks and things of that nature. And then, liquidity planning, I think, is an important part of just good planning because liquidity helps deal with change and manage through uncertainty. So, you know, ideally, the planning should be done holistically versus sort of in silos when you think about just like individual accounts. Particularly if have a household, it's the ideal way to do is like household planning with your spouse or significant family members. So we could talk about that first, and then the second pillar is about strong investment returns. So this is all about having a rational process, making expert decisions as much as possible over long periods. So, kind of analogous to health, there's no silver bullet. It's a continuous process. Both of these actually are. But strong investment returns are also a function of responding to new information, dealing with uncertainty, which is, core to how financial markets and frankly life is. And then, critical principles such as staying investing, avoiding major blunders, and then tax management is always a key part of this because returns are always after tax. So having good tax management strategies is also good. Now, on the second one, I would suggest that the advisor relationship and sort of the ecosystem that you build is a lot more important because some of these are just things that you just don't control or are not expected to have necessarily, the expertise or even the ability to control. And this discussion will be mostly about public markets, so what you do in your IRAs and things that are liquid versus, private transactions or, things such as like a house purchase of that nature. And then just, I would generally caution with investments to avoid this approach where it's gamification, where, markets are treated as like, Las Vegas, gambling. There's risk in markets, but it's very different than the notion of gambling. So with access to information and really low trading costs, I think the temptation to look at it more of like, gamification is really, really out there. So I would just caution with that. And as Jordan mentioned, there's a formal paper on this if you really want to go in depth and see what we actually wrote in that published article. So this is about the life cycle of the career and sort of where you should be at each stage, or just a general template. It was modeled after some data and views of plastic surgery. So I don't know, Jordan, maybe do we want to see where people are at in this life cycle? If maybe we can focus on if everyone's mid career or
Yeah,
early
I am
career. What do you
curious,
think is
even if you guys, if you want to use the little hand raise function, if you'll kind of play along, how many are residents or trainees? Do we have any residents or trainees here? Let's see. Or maybe even in the chat if you are. How about anyone in the first like 5 years of their practice? How about first 10 years? Anyone, even if you just put a yes. There we go. We got one there. How about first? Okay, there we go. We got a few in the first 10 years. There we go. Is there anyone like greater than 10 years out?
I like that
10 years out.
animated thumb there. Let's go out.
Yes. Okay. So it sounds like
Okay. All right. So we've got a mix. I just wanted to get that, but
perfect.
I think the general point is that it is different priorities at each stage. Generally, it's a start, build, strengthen. You achieve the goals, and then you protect and give back sort of cycle. So it's important to kind of think about where you're at generally. Overall, that's just a principle in terms of age and some of the time horizon issues. But we've got some, details of where we think our typical planning goals and investment goals at each stage. I don't have to get into like a lot of those details, but one of the key points that I will make, and I think maybe a reason why you're on this webinar, is that just having a high income is certainly not a guarantee of financial security. That's probably always been a principle, but in today's environment, I think it's particularly acute. So you just need to have other elements at play. Certainly, high income is good as the tailwind, but like financial security is the element of a lot of other things. And I'll start with this discussion with a little bit of the negatives that we see, meaning mistakes. The first one at every stage, but particularly in the early ones, is just failure to have any plan whatsoever. Or if you do have a plan, it's something that's extremely generic. It's check the box. And because it's check the box, it isn't implemented because it's not set to the actual like needs of your life. So, it's more common than you would think that people just simply don't have a plan and kind of just stumble through a lot of these issues through, trial and error. So we would advise against that, have a plan. The other mistake is just poor lifestyle choices. Maybe there's expectations for what you should be as a medical professional, but, that's not really necessarily how you should guide the lifestyle choices. Everyone has different lifestyles. Those are a lot of things that you just need to get a handle on. And then the third point there, basic asset allocation decisions. We'll talk about a little bit of why those are, impactful, but that's another key mistake. And then like really concentrated losses. If you're doing something that has a lot of unsuitable exposures, you're following fads, that's something that's a problem too. And then that last point on debt, I think, most of you probably have debt in some form, right? Whether it's a mortgage, student loans. So the use of debt is common. It is not necessarily anything that's bad. I think the point here is imprudent use of debt can be a problem. And so, happy to answer questions if that's like a source of concern or consternation for people. But to switch a little bit to the positives, so then to reflect at these different stages, bucket it into these like three main categories. Kind of what are the drivers under your control that you should be thinking about? An early career stage, it's really just starting investing as a priority, like having the mindset that that is important. It's having realistic annual household budgets that incorporate that. It's also, I think investing beyond just like the default options that you are presented with, because there's lots of other ways to invest in taxable accounts. And then it's ongoing improving your financial literacy, recognizing that as a priority and an area where you can improve on. And then at mid-career, it becomes a lot more about like how to manage discretionary liquidity, how to put more assets at work appropriately, your asset allocation. It becomes more holistic when it comes to thinking about dependence, establishing college funds and things of this nature. And then it's building an ecosystem of trusted advisors. Typical partners are tax planners, investment professionals such as myself that focus on performance, and then other professionals in the legal world that do complicated things with asset protection, which may sort of suit those circumstances. And then late stage, you get into more sort of important estate and generational planning. You can certainly position that before, but that's when it becomes sort of material issues. Then you're thinking about charitable giving, hopefully more aspirational activities about retirement where you have ability to just not only worry about financial security, but do more with your assets that are aspirational. And then asset protection, as I mentioned. And then, as the time horizon is shorter later, there's, compelling arguments that it's more of a focus on income generation, downside risk protection and so forth. So that may not be the same way you think about it when you have a time horizon of, 30 to 40 years ahead of you. So key principles always at play is, the first one is about risk and uncertainty. So it may sound like extremely basic, but really focusing on processes rather than establishing what I would consider sort of goals, like tactical goals. You need to have X, Y by a certain time. That's not as important as having processes in place to always manage, to have active approaches. You have market knowledge, you've got relationships that you can handle changes both in your own career, personal circumstances, and very importantly, with external market environment and economic changes. So think about it as a process. The next is about temperament and risk mentality. So this also may sound somewhat like amorphous, but it's quite critical. It's about self-awareness about behavioral biases. A typical one that always happens is just estimating, you may be expert in one field, but if, knowledge on financial markets, just to understand your own like ability to do that, have expert judgment. Always, just admit mistakes when they happen. Investing is about probabilities. There's always some level of mistake because it's not a perfect hard science. And just always act rationally, prudent bias. This comment on tail events, I think, we don't have to think about that as a hypothetical because we all lived through pretty significant tail event with COVID that had global ramifications. So, this goes back to the idea that anyone can forecast with markets beyond a short time horizon. It's very difficult because certainly COVID was a good example of something that's, not able to forecast. But it was adjusting to that and having an active approach that really was meaningful for good outcomes there. So let me pause, and if there's any questions, we can take them. There's something that people are really interested in on just like this pillar one.
Yeah, no, I think that's all, like, this is such important stuff. And again, I think at least for me, the cool thing, you don't often hear people kind of in the maybe financial advisor world talking about this stuff, which is really where you need to start. A lot of times it goes into the exact, well, this is what you should invest in, or this is what you shouldn't. But just being aware of these things, like you said, those two things in the gray box are huge because, risk, if you don't know your own risk, then if you don't know it based on your time horizon, that can set you up to, kind of mismanage how you invest. If you don't understand it in terms of what you can tolerate, then, you can be really susceptible to sort of being overly or under conservative and sort of to gamify things and, pull out when things are bad and sort of, consolidate a loss and things like that. So a lot of really good points. If anyone has questions, feel free to throw them in the chat as we sort of talk about this more behavioral and sort of foundational stuff. And we'll give a second for that. And if not, then we can keep moving forward and we can kind of do the full Q&A at the end as well. Okay, so Ricky has a good question. Where do debt payments fall into all of this? Sort of in the hierarchy of setting your financial foundation, because that's such a huge thing for physicians, and the grand majority of us are coming out with mid six-figure debts.
Yeah. Okay. So I think the broad answer is depends on the cost of debt, right? So one of the advantages of student debt is that it's basically subsidized on some level or capital, or you have excessive leverage. So that's something that is problematic. Student loans are typically term, the easiest to service. If you then compound that with the mortgage and it's not like it's a short-term mortgage rate, 15 years or less, that can be a problem just in terms of some bullet payments. And then credit card debt is something that always has higher rates. So if this is something where you're trying to maintain lifestyle with a lot of credit card obligations, I would just strongly advise doing that on a regular basis.
Makes sense.
Yeah.
Any follow-up questions to that, Ricky, or anyone else? All right. Well, why don't we can have you keep going, Brett, onto the next, and
Yeah,
then we'll, like I said, we'll have our full Q&A at the end as well, to kind of
sure.
tie everything in.
Okay, so let's go to pillar number 2, which is just about getting good investment returns. And let me just start with like some of the ways to do that, how to access public markets. So this very simplified graphic is showing kind of 3 fundamental ways to approach, ultimately what is just like at the bottom there, the business earning potential, cash flows from businesses that are then, manifested in public securities. And then in between theirs are the different strategies that you can, access that or, hold those securities. So I'll start with the red box on the right. I think this is not really part of this discussion because, first of all, you can do whatever you want with your money, right? Good, bad, or indifferent. You can self-direct it and hold one stock. You could do crypto, whatever. Some people have like momentum, noise trading strategies. Others, particularly if you are involved with working for a public firm, you've got corporate stock programs that are sort of tied to your employment. So that's all bucketed into the other strategies. But many of them don't work, and it's just sort of not something that programmatically you typically put in place. But the blue and the gold are 2 legitimate ways that have like advisors and really established channels to do this in strategies and products. So I'll start with the passive approach, what's called passive. The term passive can be confusing. Essentially, it means that you have products like an ETF that is entirely rules-based, right? So there's not really discretionary decisions being made about the future. You say, for example, in the case of like an ETF, you want to hold 500 securities of the S&P 500. There's an ETF to do that. You sort of assume that markets will rise, so it's low cost. There's no fees associated with that, so you build assets that way. There's also some like low cost smart beta approaches, other rules-based strategies like robo-advisory. So then on the active side, anything that's active, you're taking some sort of a judgment to say, I believe that the future is, X, right? Or I think that your risk return portfolio should be tilted conservative. You're making something and then you're executing that through either separately managed accounts, either through an active mutual fund or some sort of portfolio of ETFs, and then in a very like heavy case hedge funds, which I don't want to talk about a lot here, but that's like a manner that's a little bit more sophisticated. Typically what I see is that when you are starting earlier in the career, you're building it through more rules-based strategies when asset levels are lower, and you're sort of building the foundational routines of contributions and so forth. And then as the asset base grow, you may have a better ecosystem. You have more needs, more complexity, then you need to have something that's more sophisticated, more private bank-like. And so you kind of evolve into that. And then steady state, it can be a combination of passive and active in some cases. But there's a framework for how to think about that. And everything in there's so many products out there. I think it can be confusing to folks. So if there are questions on sort of like even foundational, like what is a mutual fund versus an ETF, it's also important to understand what you're holding and what the options are there. So any questions on this? on sort of the basics? No? Okay. So asset allocation. So the principle of investing. What is asset allocation? Why is it important? I think this graph is meant to address that question. So I'll explain it first. So there's three ETFs here. SPY is U.S. equities, the S&P 500. LQD is bond market, liquid bonds, and ACWI is global bonds. So they're really just proxies for these big asset classes. And this is a 10-year look back showing the returns of that. So even though they're all sort of passive vehicles, choosing the right one had tremendous impacts on returns. You're looking at 171% returns versus 81% returns, and then losses with bonds. So this is really just driving the point that making these asset allocation decisions is really fundamental. And then I'm going to add to this thought, I'm going to go one step below the fundamental asset allocation decision to just emphasize the importance, at least of equity, of owning good businesses. So in this graph, that SPY that I just mentioned that was at the top of the other graph, 171% returns over the last 10 years, compared to just holding Amazon and Apple, those returns are far inferior. And in fact, Amazon has just got over 1,000% returns in 10 years. Now, I'm choosing these examples illustratively. I think you would ask the question, well, can you choose these stocks? Well, I think these are such widely held stocks with established business models. There's no real secrets in here. Yes, there's analytic work that needs to be done to track them to make sure they're performing. But I think it's reasonable to expect someone to say, well, Amazon's a great business. It's like a whole forever business. So the key point here is that the return differentials have nothing to do with the cost of owning these securities. The costs in today's world are de minimis. In the case of SPY, it's a really low cost ETF. In the case of the companies themselves, minimal trading costs, but it's all about making just good ex-ante judgments versus whatever it is in terms of the products themselves. Okay, and then just a quick discussion of myths. So I'm sure everyone knows what fixed income and bonds are. We referenced bonds in terms of LQD before, but I often hear many times, well, bonds are safer, bonds are more conservative, so I should be invested in bonds. Well, that certainly hasn't been the case, particularly recently, the last 4 years, because fixed income, like any asset class, has risk. It has credit risk, market risk, and then critically, recently, it has interest rate risk. So because we have an inflation problem and interest rates went up, bond prices, on a very sustained level, have gone down. So those are losses that are embedded in bond holders. In contrast, equities, because companies with inflation can always raise prices, they have been doing that. The good companies are able to pass through inflation. They're able to show profits. They're able to innovate. It doesn't mean that equities should underperform. In fact, historically, equities have done much better in inflationary environments. So the volatility of equity on a short-term basis just shouldn't be confused with the idea that they're unsafe or anything of that nature. And then myth number 2, we already kind of discussed it in terms of passive versus active. But I think sometimes passive, that term, is used to say, well, I can be passive in my approach to portfolios. That's really not what it means. I think passive is more of like, think of it as a tool in a toolbox. So you can use passive vehicles, but every single choice you make is an active choice. When you say, I am going to buy an ETF, it means you actively say, I think the returns of the S&P 500 for example, that market cap benchmark is, the best uses of my capital. The answer could be, hold cash, could be something much different. And then oftentimes when the assumption of passive is used, it means, oh, I need to be diversified, broad market exposures. Well, most people, unfortunately, have way too much diversification. I mean, even if you hold just a few funds, it literally means you're holding like thousands of securities in most cases. Financial theory, I think, conclusively shows that you can get most of the diversification benefits by holding 20 or 30 positions, including just like stocks themselves. So I think there's also just a tendency to just be much more diversified because of this notion of passive. And then active can be confusing because sometimes active is like associated with day trading or constant trading. Oh, like I need to be at my computer and be actively trading. That's really not what active means. I think active just means you are taking a position, like having a forward judgment. And that forward judgment is you're deviating from what just the market is delivering. There's definitely some forms, like many stripes of active. There is active trading where it is daily trading, but I would suggest the vast majority of advisors, my peer set, shouldn't be doing too much trading. We are just doing the work to say we have a view and we're implementing that for clients. So I don't know if that was myths that you guys were concerned about, but I do hear it a lot, and I thought it would be helpful to just kind of go through that.
Yeah, I agree. I think that is helpful, and I'm sorry for jumping in before you finish. Especially, I mean, the whole active passive thing is obviously a really hot button kind of issue, and I think your points are well taken, and this is obviously a discussion we've had offline as well. But it's not necessarily meaning trading, etc., but you are actively setting your strategy, and whether that is picking funds, for the long term, and you're working to minimize costs and tax and stuff like that. So it is a really important thing to understand the spectrum there, because there is the tendency, you're thinking of constant trading and trying to time the market, which is, what you're saying via gamification and things like that. It's just not, not something you can do, if you don't already have a plan set for how you want to manage things. And so you do, even if you're investing in broad index funds, you need to actively have that plan in mind and how you're gonna, respond to things. So I think that is a really important perspective. So I just wanted to throw my 2 cents in there before we moved on.
Yeah. Market timing is extremely difficult. That shouldn't be what that's not what good active managers do.
Yeah.
So
And I think unfortunately that's what a lot of managers, again, I think there's obviously a wide range in the quality of investors, same way as with any profession. But I know certainly when I was starting, and I think we talked about this, a couple investors that my wife and I met with, and we were at that point still very naive and hadn't really started our financial education, but retrospectively looking at, we're offering a really risky and kind of dangerous strategy. So it's like stuff like this, and having this information is really important, because like we always say, you have to at least go in knowing kind of the good advice from the bad advice a little bit, to make sure you're not being taken advantage of. So that's why this information is so important.
Yeah. I would also suggest don't invest in anything that you don't fully understand. And if they can't be explained simply to you, then I think it's a problem of the manager or the advisor to make sure that it's like non-technical. So,
and that's
right.
that's
So
literally like in the talks
lots
that I
of
give
products out there.
yeah. In the
Target
talks I
date
give,
funds.
oh, sorry, Brett, I keep jumping in. Go.
Yeah, I'm gonna point my finger at target date funds. If you hold target date funds, I don't understand what actually they are. They've been semi poor performers. And I would just suggest that you need to like learn more about target date funds because there's so many better options than target date funds. It's one example. So,
Yeah, I was just saying in terms of like when I talk to residents, that I say the same thing basically. Like if you're ever being described any sort of investment, you don't understand it. It's either the person you're talking to doesn't understand it, which is obviously not good, or like they're purposely trying to make it seem so challenging or something that you know you feel like, oh, I need this expert to do it. It's like any surgery I do, it's not the patient who's going to be doing surgery on themselves, but I need to present it in a way that they can understand it. If if you were with some physician, they were describing something to you that you just couldn't understand or even fathom,
yeah.
you wouldn't necessarily have the most trust or faith in that person. Anyway, so go ahead. I'm sorry for interrupting.
Yeah. Okay. So those are some like key highlights. I mean, if there's interest, I can talk about just today's market conditions because I think there's some important like um, aspects of it that are pervasive in terms of just thinking about what to do with money now.
Yeah,
That's
we
something
have
that
like
would.
50 minutes. Let's definitely let's hit that and then we'll leave, a little bit of time for Q&A as well.
Okay, I'll try to do this quickly. All right, so this time is different. Like, is it really? Well, in some aspects, it is different now. I think we are. This is to sort of paint a very broad picture of the last 4 years. We went through a pandemic. There was so much financial stimulus, tech changes in our daily lives, lots of stay-at-home changes. Some of those are like super persistent, lots of knock-on effects. We quickly went into sort of a hot war situation, a real big inflation problem as a result of some of the stimulus from the pandemic, and supply chain disruptions, all sorts of other factors. But that's now combined with a lot of like military escalation issues, geopolitical concerns, hot wars in the Middle East and Europe. So I would just point like pretty coherently to these two dominant trends today. I'll call one of them old and one of them new. So the first one, the old one, is that money is now not free. We had a lot of stimulus, lower rates, 10 years. Now it's sort of normalized. So that's kind of going backwards. And we're also localizing distribution, supply chains. There's almost like a national security sort of a dimension to a lot of global industries now. So that's happening. That's also pushing up some costs. And then we've got sort of defense spend hiking and what I'll call nonlinear events, meaning like hot war, like really nasty, really fast. And those are like pretty big political events. And I would argue that we have domestic instability too with elections. So those are kind of like old concerns, but they're acute now. And then on the new side, which is arguably a positive, is just really next gen AI tech opportunities. And NVIDIA, if you guys have followed that, it's in the press. It just continues to have amazing proof of concept, at least with them creating the chips. But it has created a lot of momentum in markets. I think that's good. I think it's almost like an arms race in AI. It's ultimately probably going to impact many businesses, including medical profession. But tech adoption, productivity gains, these are all characteristics of more advanced economies. That's partly the reason why the U.S. markets are doing so well. But there's other developed markets and so forth. But I think this is useful to understand these two dominant trends when you just kind of think about where to fish in the ocean. And then I will go then to just make some comments on today, like this conditions for this year. Markets are at all-time high. Equity markets are. That's reflective, I think, rationally of a strong U.S. economy. We've got really low labor rates, surprisingly resilient consumption for now. Corporate profits are good. Share buybacks, companies are buying back their shares. That's an investor-friendly action. Mentioned AI, it's more than the hype. Energy and commodity prices, as you know, if you fill up your tank, elevated, and that's likely to stay. So that creates opportunity in those sectors. And then, just from a pure yield perspective going forward, you can now, should try to get more from your money, even in relatively safe positions like money markets that pay higher than at least inflation. Like nominal yields need to be much higher than inflation for you to accrete value. So places to look: semiconductors, big tech, the Magnificent Seven, global defense contractors, and then energy is something that has been very successful for us. To me, it's continuing, and it's like a geopolitical hedge because energy markets tend to rise in like cases of stress. Places to sort of stay away from are any firm that has leverage, because the cost of debt is so much higher today and shall be for quite some time. There's a lot of problems in the commercial real estate market. Try to shy away from that. Banking sector holds a lot of that debt, so there's all sorts of hidden traps in banks. We had some major bank failures just a year ago. Don't think that's resolved yet. And then on the consumer resilience point, certain pockets are certainly showing strain. It's not terrible yet, but that's something to monitor. War escalating, obvious. China's in a deflation. That's a problem. So generally, if you're trying to think of where like companies to buy for businesses, and then look at the competitors, if they're third tier competitors, they're not showing profits, and they have lower growth, they will be punished and have been punished. So there's a degree of like work in those selection that you need to do if you try to do it yourself. So those are my quick comments. This is our last slide. Maybe this is where we can like go to Q&A, but we put together these questions. They're in the paper. I think this is part where you kind of think of yourself, whether you can answer these questions all affirmatively positive, or if there's areas where there are negatives or maybe like need work. The more yeses you have, then the better shape you're in, I would suggest. The more no's, maybe it's time to sort of up the game, think about solutions, potentially talk to an appropriate person, depending on the situation. But they just, I think they relate to, things. In some cases, they're just changes in your life, such as having, a new child or changing a job, making a major decision, a major relocation. These are all things that can impact how you manage your financial security. Buying a new house is another big one. And then just some of the opportunities to make sure that cash is always working. And then the last point there on the left is about liquidity. So a very common problem, we've also written on this, is just your best protection from a risk perspective is oftentimes just to make sure that you are liquid. And that can also be misinterpreted, because liquid assets in retirement accounts are generally not something that you can touch until you're at least 59, and you generally don't want to do it until you're 70. So I think imposing some understanding of your liquidity position is really important. It also relates to the concept of how much debt, right? So debt is a tool, but a risk when it comes to liquidity. And by liquid, I mean like investable assets. It doesn't have to be sitting idle in a cash account. It just has to be what you can access in a reasonable period of time, a liquid asset. That's also why we think public equities are, attractive, on a core level, because, circumstances change, you can access your accounts, your taxable accounts, if they're not in retirement accounts. That's why you want to build up like kind of the war chest and do that. And then on the investment performance side, just I think an honest review. Do you really understand your investments, number one? And do you have products you don't understand? And then, how are you doing? Like, are you even tracking performance, right? I think, this we do, it's sort of like baseball. You do a lot of tracking, but it's a tool for you to understand if you need to make changes, if you have really captured other appropriate opportunities that are available, because there's thousands of choices on how to deploy your capital. But it also depends on your risk. If you're a conservative investor, you probably expect lower returns. But just merely understanding what your holistic return base is something. When I onboard new clients, I actually rarely see it. And then if you do have an advisor, is it a relationship that is salesy, meaning you don't really trust them and you deal with sales managers, or are you talking with the people that are actually making the decisions, and are they accountable for those decisions? I think that's sort of basic, that you have to have accountability, and the preference is to work for those that are actually doing the discretionary management. And then I mentioned the siloed approach in the beginning, but just doing things in the IRA and the taxable account, but they're overlapping and they're not doing the same thing, and maybe they're correlating risks. It should be looking through the account types and also considering your overall financial picture to do a coherent strategic plan. So you can ask those questions. I would be curious if there's any that people want to mention stand out to them, that they feel there's deficiencies. I think the whole reason why Jordan and I are doing this, and this doesn't this is one of many activities, is that financial literacy within medical professions, even though amazing incredibly smart people, great at their field, I think financial literacy isn't formally taught in medical schools. So sometimes it's deficient, and it's important. So that's kind of our ethos and reason why we're doing this, and why I'm sure, Jordan, you're doing your work as well. The website.
Yeah, exactly. And that's why, I think this is incredibly, helpful, and such a good primer and kind of understanding, and also getting into the whole, investment aspect of it, even beyond just the behavioral aspects, which are super important as well. So we have, I want to be respectful of everyone's time. We have like 5-ish minutes or so. Are there any questions? Feel free, obviously you can unmute yourself, put your video on if you want to ask, and or put them into the chat box. Ricky has a good one. I knew Ricky would have some good ones here. Does an active management underperform passive index funds due to fees other than DFA or Avantis funds? 99% of active funds over time underperform a passive index. And so this is something, that's often quoted. So what's your sort of, what's your response to that, Brett?
Yeah, no, I mean, I think this is part of the confusion. Well, first of all, we're active managers, and we have consistently outperformed for 12 years. It depends on the active manager. What you're referring to is like a head-to-head comparison in a mutual fund context between a mutual fund that has a specific mandate, lots of rules associated with it, and sort of the index that they're trying to achieve. That's just one sleeve of the active-passive debate. And actually, there's some active funds that do outperform benchmarks. I think that's a version around that. But what FAs do is very different than that particular debate. I mean, FAs use tools, a lot of ETFs now, models, holding companies, to achieve outcomes, which in many cases are better than indices. So I'll just go back to the point. Holding a basket of 5 great Magnificent 7 firms, making that judgment call, clearly outperformed very, very diversified market benchmarks. And I don't think there's financial research. I'm a CFA. I'm not aware that they would make that claim that passive outperforms. I think it really depends on the case. And if that were the case, there would be no FAs or advisors, and there's 100,000 of them in the industry, and probably 16,000 different RIAs.
Yeah, and I think there's a lot of I'm obviously a big proponent of I invest in index funds as well. I do think that, you know, those studies, it's like anything, even in medical studies, the ones there, and I've looked them over a lot. I mean, it's a comparison of a very specific kind of interactions and stuff like that. And again, it is, if you are actively trading or trying to time the stock market and things like that, and some of these very active investment funds and things like that with high turnover ratios, that obviously generates a lot more fees and everything like that, and certainly leads to underperformance, versus sort of a more holistic style, you know, correct me if I'm wrong, that I think, Brett, you're espousing, which again is more of a long-term kind of holistic thing that's not a time the market or just pick. Um, you know, so it's always a really tough discussion, and I think you have to, again, determine what kind of active, because like we said, there's active investing that is clearly not the answer in like trying to time the market and
Mutual funds,
actively,
yeah. I would just
pick stocks.
broadly compare mutual funds, yes, just on that level. You should, of course, try to find a cheaper equivalent that doesn't have fee drag. And mutual funds should not be overcharging their clients to do their service. The problem with mutual funds is that's many times the only option in a lot of like 401k programs. So it's just more of like an industry problem and the tradition of the mutual funds.
Any other questions as we kind of get to wrapping up?
Hey guys, if nobody else has any further questions, Brett, thanks, a great discussion, man. Jordan, thank you for all you do, man. And are you on the cover of Stitch magazine in the background? Like, it's like behind you.
Oh, that's our plastic surgery newsletter. Yeah.
Oh, you're famous, man. So Brett, also back to your point about diversification. Yeah, maybe 30, 40 stocks is diversified, but doesn't that mean though you might miss out? I know there's research by a dude from ASU, Dr. Bessenbinder. 4% of the companies that ever existed account for 99% of the returns of the stock market. So even though you might be diversified, yes, the correlation goes up with just 30 to 40 stocks. You might miss out on those 4% of companies, and so the return, you might miss a huge return because even though you're diversified, you're just diversifying correlation, and you might miss one of those big companies like Amazon or something if you're just diversifying with 20, 30 stocks. How do you feel about that? And when you actually sort of advise clients, is that why you will go to an index fund because of Dr. Bessenbinder's research?
Great question. Yeah. So I think the assumption with the 25 to 30 positions is that they are diversified by large cap, by sector, by sort of the representative winners in their class, right? So they could be components of the benchmarks that you're looking at. This is not something where if you have, 35 small cap industrials, that is a problem. So it's just if they're properly diversified, they don't need to be funds. So we don't really do funds. And example would be amongst the like big tech names, a good proxy, the large holders there like Google and Amazon. You largely get the same returns. You may have missed NVIDIA, but that's part of your judgment call. And then in the world of like other sectors that are represented in the broad market, picking 2 or 3 winners in industrials is a way that you construct portfolios. So if you don't do it correctly and you have loser, like your work is absolutely wrong, where you're choosing the loser stocks, not the winners, then no doubt you would underperform. But I believe this goes back to the 60s that there's substantial evidence that that diversification of positions is robust. The 25 to 30 numbers. There's been a lot of research on it. Happy to share some more like in-depth financial like studies on this, but it's of course critical point of like portfolio construction. The general point though is you do not need as much diversification as almost everyone holds.
Cool. Another question too, how do you best assess a client's risk tolerance? What do you do? like questionnaire or something, or do you wait till they go through a bear market first and see how they react? How do you go about doing that?
You have the basic generic stuff, but it also is about goals and personality and like immediate circumstances. I mean, fundamentally, it is about your time horizon, but even that doesn't fully justify it. A 75-year-old with a lot of assets and certain goals is able to have a 100% equity allocation because they have that capacity to do that. So it is about that client relationship. There are some like basic principles, but if someone is not tolerant of taking short-term volatility and you speak to them and they still are not tolerant, I don't think it's appropriate to, impose that, even if it's philosophically the best thing to do. I think you only can present the rational arguments, and there are cases like that. And then it depends on your liquidity needs, right? So if you need cash and you think there's a risk there, then having more volatility is going to be a problem. So time horizon, total asset wealth, risk tolerance, and other factors.
Awesome. Well, Brett, thank you so much for your time, and thank you everyone for joining, if you're joining live or if you're watching the recording. I think this was a really awesome discussion, and I know I learned a lot, I'm sure. Everyone hopefully did. So Brett, if people did, we're going to be sending out an email, and I know you had a very nice follow-up survey that we're going to include. If someone wanted to reach you, what's the best way that they could do that?
Yeah, no, I would love to, if there's interest, I'd love to do an exploratory conversation, see if we can, what the problem is. If I can simply help by providing some advice, that's great. But, I believe in working with experts, and I'm happy to engage with anyone that has specific issues and would just like to, have a resource. And we can send around my email, and we can do another session on a specific set of issues that are like people are concerned about too. I'm happy to do that. A lot of this is about, the best clients are the ones that are most educated, right? And that interests are aligned. So the more transparency and knowledge you have, absolutely better, in my opinion. So, because it's also just a pure partnership. Pillar 1 is mostly under your control. Pillar 2 is something you hold the advisor to be accountable for and deliver. But it has to be both working together holistically.
Awesome. Well, thanks so much, Brett. Thanks,
okay,
everyone.
Great. Thank you so much, everyone. I really appreciate it.
We'll see you soon.
This was helpful. Okay, take care.